Good morning. My name is Jason Pandak, Vice President in Debt Capital Markets at AmeriVet Securities. I'm joined today by our Head of U.S. Rates, Gregory Faranello, CFA. Good morning, Greg. How are you?
JP, I'm great. How are you?
I'm doing really well, and I'm very excited for today's discussion. Obviously, as we were talking before we started this, no shortage of things to talk about. And so I did want to kind of jump right in because there is plenty to cover. And so if you could just kind of the Fed meeting started yesterday, it's going to wrap up today. There'll be a press conference. If you could dive into that a little bit and just look at what you think is going to happen and what you expect to hear from Chairman Powell this afternoon.
So no formal move on rates in general. The market I think is priced appropriately right now. If you look at the press conference, you know he's going to talk about the economy a little bit. He's certainly going to talk about geopolitical risks. He's going to talk about the rise in energy prices, what that could mean for inflation over a prolonged period of time, and And then they're going to question him in terms of what his future looks like. I mean, his term as, Kevin Warsh is going to be the next chairman of the Fed, but his term as Fed governor goes through 2028. So technically, he could stay on the committee. Our view is uh, if Kevin Warsh gets confirmed, which we think he will, the chairman will likely step down, but there are going to be a lot of questions around that. And then, in terms of forward guidance, we don't really see much at this point because no one really knows. I mean, even if you look at markets today, very dynamic. Rates are bumping around. No one really has all the answers right now. So, we expect the chairman it will be his last presser as Fed chair. He's a pro, and we expect him to keep it short and simple.
Gotcha. Yeah, totally agree with you. You mentioned, I should say, nominee Warsh to be the chair, and I think what's really interesting is if you asked someone a couple of years ago, is Warsh more of a hawk or a dove in terms of inflation? You probably would have gotten a different answer than if you asked them after he was nominated by President Trump, because President Trump has been very vocal about his view on rates, although in the past, maybe few days or week or so, he may have changed his tune. So if you could just talk a little bit about what you see as a difference between, let's assume he gets confirmed, a Chairman Warsh versus, Chairman Powell in terms of the outlook for rates and maybe some of how they view the balance sheet and the different tools the Fed has to use.
Yeah, so I think he's going to be creative. He certainly historically, if you look at his background, he's definitely more of a hawk than a dove. And in conjunction with that, if you listen to what the president has been saying, yes, he's been much in favor of lower rates. I have too, but having said that, he has changed his tune recently. So, he's being advised by Secretary Bessent. He's being advised by Kevin Warsh. Yeah, the biggest concern right now, I mean, the labor market seems okay. I think the biggest concern, if I'm sitting in the president's seat right now, it's on inflation. And so I think that's where the focus is. I think Kevin Warsh is going to be a great Fed chair. I think what will change, and we've always said this, regardless of who the Fed chair is, they're not just going to come in and blindly lower rates. They're not going to do it. And I think that message was sent loud and clear. I think the biggest change, which will come out of the next Fed chair, is on communication. So there's going to be a lot less communication. And we're going back to the old days. I mean, I grew up with the heyday of my trading days were under Alan Greenspan. I mean, there was very little communication, and you're smiling and laughing because
If I
it's
remember
a
correctly, they had the binder watch, and if you had a thick binder, that meant one thing, and if you had a thin binder, then that meant a different thing for rates. But it was certainly just a completely different amount of communication from the Fed compared to what Chairman Powell has given the markets. How do you think the markets will react to that? I mean, they've gotten a ton of communication from the Fed, not just from Chairman Powell and the pressers, but from all of, across the Fed, really consistently until they reach their blackout period. Do you think the market is going to be able to take that in stride, or will there be some hesitation?
There should be volatility back in the marketplace. There's no question about it. I mean, if you look at the institution, if you look at the Fed as a whole, if you look at the last past Fed chairs, they've been very much in favor of forward guidance, and you're not going to get that from Kevin Warsh. And I think that's going to be the biggest change. It could create volatility, and look, volatility is not a bad thing as long as it's good volatility. Right now, we're not having good volatility, but if markets bounce around and are volatile because the Fed is not necessarily giving guidance, then ultimately it leans back to corporate earnings, and it leans back to the economy. So, what are you hearing from clients?
It's really interesting. I think our clients, when we talk to them, when the conflict with Iran started, obviously everyone pumped the brakes. Um, I'm not going to say that everyone is back and ready to issue, but certainly markets have opened up more than I would have anticipated given the stress. I think our clients are trying to understand the curve and where it makes sense for them to issue. It's a relatively flat curve, certainly not as inverted as it was, a couple of years ago. So I think we've, you know, normalized a little bit, but it's still relatively flat. And I think a lot of our clients are trying to understand, can they go out the curve and lock in some duration for lower rates, which is an opportunity. And we were just having a call the other day, and the difference between, say, the 20 and the 30 year, it's just not a huge amount. And so it will be interesting to see if the curve shifts. They're also interested in the spread to treasuries, but that has stayed relatively stable, or I should say advantageous for our clients is the way I'll put it. And they seem quite happy with that. It's certainly been interesting, and I think it's more about a combination of what makes sense on the curve versus what their needs are in terms of their maturity profile. You mentioned inflation. I think if you had gone back 2 or 3 months ago and you told someone both West Texas Intermediate and Brent crude are going to be over $100 a barrel, they would not have responded with, "Oh, sure," and the S&P is going to be basically at all-time highs. How long do you think the market's going to be able to stomach these higher oil prices? Or I think the follow-up I have is, are we okay with $100 a barrel oil as a market?
I don't think we are in general, is my personal view. My view has been, well, one, short term, if you look at the tips market, I mean, inflation expectations have gone up short term, which they should. If you look at inflation expectations out the curve, they're actually pretty well contained. So the market is saying the market-based expectations are saying to a large extent that this is going to be a short-term phenomenon, which I think it will be. So I think there are a couple of things going on. One is, what is this? To me, it's a supply shock in the end. It's a flow shock. And we have plenty of energy here. I mean, there's plenty of energy out there, right? I mean, not too long ago, WTI crude was at 58. So I think it's very, very clear it's a supply side shock. Now, the geopolitical dynamics are very tricky, right? Because the players abroad don't have an invested interest in getting oil down anytime soon. So, the president, he certainly has his work cut out here for sure. But you know, in general, how long do I think this can go on for? I mean, not too much longer, but we're going to need a couple of months, I think, to work through this. And, you know, once we get through those couple of months, we're going to be in summer months. And if oil prices are still here as we get through the summer, ultimately my view has been this will come out of growth. So inflation remains higher and growth maybe comes down. But when I look at 10-year yields, you look at what they're doing today. I mean, it's very dynamic. We're right at the upper edge, you know, 440 and 10-year yields. I mean, we're from here, we're going to track oil. If oil continues to go higher, I think yields continue to go higher. Ultimately, if yields continue to go higher, then it's gonna take a cut in growth, is my view.
Yeah, no,
Does that make sense?
yeah, makes sense to me, and I tend to agree with you. The only, the last thing that I think I'd like to talk about is just, you mentioned that 10-year, you mentioned where it's at now. Obviously, administration would like a lower 10-year, if we assume that over the next couple of months, the Iran situation works itself out, that oil comes down to, somewhere around what it was trading before. Do you see us going below 4% in the 10-year this year, or is that going to be a bridge too far?
I think that's probably going to be a bridge too far. I mean, if you look at the range in 10 years, really since the Fed started to higher rates aggressively, we've been 350. We had the regional bank crisis. We came down. We've been at 5%. So we're still, even, locally here, I mean, we're at the upper edge. But if you look at the context of the range that we've been, we're still in that range. Do I think we get below 4%? I I don't necessarily see it because I think the policies in the US are actually very constructive. I think the economy is going to be in okay shape. Now, if oil prices continue to move higher, we could have some issues there. But, in general, yeah, I mean, I think getting below 4% is going to be a bridge too far.
Gotcha. And I think that's where I'd like to end, is that you do think that even with a 10-year above 4%, we could still have a very constructive economy towards the second half of the year.
I think so. Yes. I mean, I think, from an investor perspective, I mean, you talk to the issuers, right? They've adapted to a higher rate structure. From an investor perspective, any backup in yield from here, they're going to view that as an opportunity, assuming credit spreads stay relatively contained. So could we move higher in yield from here? I think the answer is yes. Should we move meaningfully higher from here? I I think the answer is probably no. So I think ultimately any backup in yield from here is a good opportunity. Issuers may not be happy with it, but investors will.
I think you've got that one right on the money, Greg. And obviously there's a lot going on. I do want to remind all of our clients that Greg and the rest of the AmeriVet team are always available. Just talk with your uh, coverage team member, and we can get a call set up for you. But until we get a chance to speak again, Greg, it's been a lot of fun, and I know you're going to be watching this afternoon's press conference quite closely. Look forward to hearing your thoughts on it, a later day and tomorrow.
Thank you, JP.
Thank you, Greg.